In this video, we are going to discuss RAP 2026, in which we are discussing some points which are very helpful for future videos. So watch the video till end.
For 43 million Americans with federal student loans, the current repayment system is being dismantled and replaced by a new, singular framework. Following the One Big Beautiful Bill Act of July 2025, the U.S. government is preparing to launch the Repayment Assistance Plan, or RAP, on July 1, 2026. This chart shows the migration of 43 million accounts. The legacy SAVE plan has already been eliminated, with its participants transitioning into the RAP system. The remaining options, PayYE and ICR, will also be phased out by July 2028. This leaves the majority of borrowers with only two choices: the new RAP system or a standard fixed repayment plan. While RAP introduces new government subsidies, it changes the basic calculation of student debt by moving the assessment base to your adjusted gross income. Although the policy is designed to streamline the repayment process, this new structure introduces specific risks and potential cost increases for those previously enrolled in the SAVE plan. The primary point of friction in this transition is the removal of the $35,000 income shelter used in previous calculations. This comparison shows the shift in the assessment base. The left scale shows the old SAVE formula, which used discretionary income. The right scale shows the new RAP formula, which uses your total adjusted gross income. Under SAVE, the first $35,000 of your earnings was removed from the calculation entirely before your payment was even determined. RAP changes this. The calculation block now encompasses your entire adjusted gross income, minus only specific pre-tax deductions. The plan does include a baseline floor. For those earning $10,000 or less per year, the monthly payment is fixed at $10. For incomes above that floor, RAP applies a sliding scale, taking between 1% and 10% of your total AGI, depending on how much you earn. The only major deduction remaining is for dependents. Your monthly bill is reduced by exactly $50 for every child or dependent you claim. Because the formula now assesses your total income without the $35,000 shelter, middle-income earners will mathematically see higher monthly premiums even if their percentage rate appears low. This sliding scale creates extreme sensitivity at certain income thresholds. Look at how payments climb on this chart. Without a standard floor deduction to smooth the transition, the rising gradient can create sudden cost increases as you cross into higher brackets. To see the impact, we can look narrowly at the $60,000 mark, where a tiny change in income triggers a significant shift in the formula. A borrower earning $59,999 falls just below a specific percentage threshold, resulting in a predictable monthly payment. But earning just one more dollar to reach an AGI of $60,000 moves the borrower into a higher tier of the sliding scale. That single dollar of additional income causes the annual payment to jump by $600. This means standard cost of living raises could inadvertently leave some borrowers with less take-home pay because of how the RAP algorithm scales. This mathematical quirk makes student loan repayment more volatile, requiring borrowers to manage their income with precision. To balance these higher monthly costs, the RAP plan introduces two structural subsidies designed to prevent debt from growing out of control. Historically, many borrowers faced the problem of negative amortization. Even when they made their full monthly payments, those payments weren't enough to cover the interest, causing their total debt to increase every month. This ledger shows the first subsidy. Under RAP, any monthly interest that isn't covered by your payment is waived by the government. Because the government absorbs this interest, your loan balance is permanently capped, meaning it can no longer grow while you are making payments. The second subsidy is an active contribution toward your debt, the principal subsidy. If you make your payment on time, the government contributes up to $50 directly to your principal, which actively shrinks the total amount you owe. These mechanics shift the nature of the loan. The system now uses higher upfront income assessments to fund the long-term decay of the principal balance. Forgiveness is also being restructured, with new timelines for those who don't pay off their balance in full. Most older plans offered forgiveness after 20 or 25 years. RAP extends this requirement, mandating 30 years of payments before any remaining debt is wiped out. However, the Public Service Loan Forgiveness Program remains a critical exception to this rule. Borrowers in government or nonprofit roles still qualify for total forgiveness after 120 payments. maintaining the 10-year timeline. There is an immediate deadline for the 7.5 million people moving from the SAFE plan. You will receive a notification letter opening a strict 90-day window to choose your next step. You must proactively select a new plan within those 3 months. If you fail to respond, the government will automatically enroll you in a default repayment plan. This auto-enrollment process rarely accounts for your specific financial situation, making it likely that you'll end up with a higher monthly bill than necessary. To manage the costs of the RAP plan, borrowers need to focus on a single strategy: AGI suppression. Because RAP relies on adjusted gross income, contributing to pre-tax accounts like a 401k lowers the income used to calculate your loan payment. Maxing out a health savings account directly reduces your AGI, lowering your monthly bill. For married couples, filing taxes separately can also be a viable strategy to prevent a spouse's income from inflating your individual loan payment. For those in public service, be extremely careful. Switching plans without proper verification could reset your progress toward the 120 payment forgiveness goal. The first step for every borrower is to log in to studentaid.gov and confirm exactly which plan you are currently on. Use the Department of Education's loan simulator to compare RAP against your other options, so you can see the math before the 90-day window closes. The RAP framework shifts student loans from a passive monthly obligation into a math-heavy challenge that requires active income management to navigate successfully.
Subscribe to this channel for more such valuable videos, and hit that like button if you genuinely liked the video, and comment for more suggestions.
वीडियोस बनाने हैं, फिल्मोरा है ना।